Welcome to Farm Here Daily, a Field Forward podcast. I'm David Geiger, your host. I've been on Iowa TV and radio for the last decade, and I am excited to join you on this podcast, Farm Here Daily. Today on the program, we're going to continue chatting about that June acres and stocks report with market analyst Al Kluis. Please be sure to like and follow the podcast. Make sure to send it to your friends. Check out our social media at Field Forward Pod. We would love to have you all join our community, keeping folks informed about what is affecting our farmers. This is Farm Here Daily. And joining us on Farm Here Daily, we're going to continue talking about the marketplace. We have Al Kluis, Managing Director of Kluis Commodity Advisors. Al, I'd really like to chat with you about what went down yesterday, the USDA report that happened. And first off, how are you doing, and what was your initial impression of it?
Well, I was really surprised, David. I've done these reports for 20 years. We do webinars with them. We do our own surveys. The numbers are so close to what the trader expected and so close to the March reports that historically, this is the day of the report is a very volatile day. If you go back, excluding 2025, you go back previous 5 years, and you had an average trading range of 38 cents a bushel on corn, 62 cents a bushel on soybeans, and yesterday we had a whopping 13 cents on corn. So certainly the people that sold the options kept most of the premium. And I just scratched my head because I wondered how did we end up with less corn and less soybeans than what we expected in March. And I question if in the future reports, and these numbers will be adjusted based on prevent plant acres in August, that we might see something different at that time.
Especially where I'm at, lots of ponding going on with the tons and tons of rain in northern Iowa, at least. So there might be a little bit of issues down the line. But what really shocked me and what I noticed when I was tagging in on your webinar was I noticed that the trades seemed to have a pretty good finger on what the planting or what the acreage expectations were.
Yes, they did. I think people are getting better with the surveys. We're seeing farmers and seed companies cooperate, and so the numbers are kind of it's not like the old days where people would shift a huge amount of acres between March and June. Once people have their cropping plans in place, seed and inputs bought, it's really hard to make it to shift over. One thing, and when you look at the total crop acres in the U.S., say about in the 19 principal crops, 319 million acres. The biggest jump we saw was in hay. Corn inputs were expensive. You really couldn't project a profit on new crop corn or soybeans. So having hay, cattle prices were high, and that was an alternative that a bunch of people looked at. So that was interesting. It's been, I think, a couple of decades since I've seen that. The other, not part of the USDA report yesterday, but just some from our own surveys, is that when we ask producers, what are your corn acres versus last year, bean acres versus last year, wheat acres versus last year? And we also asked prevent plant. And what we saw was about a 51% reduction in prevent plant acres. And so farmers need to report their acres to the FSA by the middle of July. So in August, the USDA will plug in updated acreage numbers for corn, soybeans, and spring wheat. And my fear, in all honesty, is that numbers of all three could be a little bit larger because we're seeing historically Dakotas are where a lot of your prevent plant acres come in. They had a very dry spring, and they were able to plant through every wet area, every slough that they had.
When you talk about how that might be updated here, did you say next month? What might be a result of that announcement?
You could see if you see some additional corn and soybean acres, and they continue to project trendline yields, you could see a larger crop supply being projected for the 2025 crop year. So yield will be the big variable, and I'm not talking, David, of a massive swing, 3-4 million acres. I'm thinking 500,000 to a million acres, but every million acres more corn gives you 180 million bushels more corn that we have to slug our way through. Every million acres additional beans is 51 million bushels more beans. Now, we need the beans. The ending stocks are so tight, but corn, if we would come in and say, let's say that rather than the 95.2 million acres USDA came out with yesterday, if they come out with 96.2 million acres, that's quite a change in the supply and projected ending stocks.
I'm glad you brought up every million acres counts, because something I noticed in the report was cotton acres went down by 10%, which sounds like a lot, but it's about a million acres or so. Is that something that southern farmers are going into more corn and beans then?
Oh, absolutely. Yeah. The cotton acres, we're really disappointed in current, new crop corn and soybean prices, but cotton new crop is lower, and they've hadn't had a good opportunity here for a couple of years. The other one that we're seeing a shift on that I think could become permanent is away from spring wheat. The people up there, farmers that had 100 bushel per acre spring wheat yields last year, and between the futures price, protein discounts, falling numbers, they lost money growing 100 bushel per acre wheat. So they just said, okay, we're going to be going more corn and soybeans. And we saw a big shift in North Dakota to more corn and soybeans. And we took the spring wheat acres from 10.5 million acres down to about 9.75. So about 750,000 acres less. Now, you take the cotton acres down, increase that into corn and soybeans, take spring wheat acres down, shift into corn and soybeans, and we don't have to find a whole lot more acres in the U.S., but we are shifting towards more oil seeds and corn.
Just because you were talking about wheat, it brought up to mind a bit of a rabbit hole. So I noticed we just got the fourth contract of wheat. I think it's spring wheat Minneapolis on the board just this past month. Is that something that's influencing some of that, or what's your take on that addition?
No, it's interesting. Now the CME Group has a spring wheat contract, and the Miami Group that owns the Minneapolis Grain Exchange has got their own contract. But we're seeing wheat, I think, that really dominated not by the exchanges, but just by lack of profitability. A lot of the farmers that can grow corn are looking at trying to objective of grossing $1,000 an acre on corn, and basically that's what you need depending on your land cost. On soybeans, they're hoping to get $800 an acre in gross revenue so they can break even. Many people need about $900 an acre to make an operating profit of any kind. And when you look at new crop wheat prices at $6 a bushel, take off a 50-cent basis, if you grow 80 bushel wheat, you're only grossing about $400 an acre. It's just not competitive. Now, some farmers will do it because of the rotational benefits, but if you're paying cash rent on land, you got to make that cash flow every year, and that's been really challenging to do for spring wheat producers the last several years. Winter wheat producers historically can get a crop of winter wheat, say, 80 bushels an acre, sell it for $6 a bushel, then come back and get an almost normal soybean yield where they're able to double crop. And so the revenue between the winter wheat crop and the soybean crop adds up to a very acceptable number. But the spring wheat guy that's further north, planting in May, harvesting in August, the revenue per acre just isn't there. So that's where we're seeing more go to corn, soybeans, canola. The same thing true, David, north of the border, where canola acres has been surging, and we always think of Canada growing all its spring wheat. Well, I think we are, or will very soon be, seeing canola acres surpass wheat acres.
Hey, I'll hold that thought. This is Farm Here Daily. We're going to take a quick look at the marketplace before continuing. And it looks like there's a bit of a mixed trade going on at the Tuesday market close after the USDA report on Monday. July corn half a penny weaker, 4.20. September 3 1/4 down at 4.06. Soybeans in July half a penny higher at 10.24 3/4, with August unchanged at $10.29 3/4. Soybean meal in July $2.10 a ton in the red at $269.20. July wheat 8.5 cents higher at 5.37 1/4, with September rising 10 3/4 at 5.49. In the livestock market close for Tuesday, August live cattle $3.12 a hundredweight lower at $210.75, with October falling $2.37 at $207.80. Feeder cattle in August, $4.65 a hundredweight in the red at $306.02, with September falling $4.97 at $305.65 a hundredweight. Lean hogs in July, $1.10 a hundredweight weaker at $109 even, with August falling 55 cents at $106.95 a hundredweight. That is the Tuesday market close. This is Farm Here Daily. Al, going back to the USDA reports we got yesterday, I wanted to take a look at stocks. Was there anything significant you noticed out of that side of the report?
Well, a little disappointed that the stocks were as high as they were. And the explanation that I look at is that we're not feeding as much as we thought. We should have a pretty good handle on corn exports each week, which have been really outstanding, and corn crushed for ethanol each week when we get the EIA report. So it came in a little bit higher than I thought, certainly a lot higher than we were last June. Soybeans, too. I really wonder, looking at the soybean numbers there, we should have very accurate stocks indication because every week we get the crush report, every week we get exports. I wonder if possibly last year's USDA understated this total soybean crop by 20 or 30 million bushels. So just a couple of factors that jump out on me. And I always look at what are the numbers versus what the trade expected, and then what are the numbers versus a year ago. And when you look at corn, soybeans, and wheat, our inventories of all three are certainly larger than they were a year ago at this time.
Looking forward, now that these reports are in, they weren't as volatile as folks thought they could be, which could be a good thing as well. What are your expectations moving into the rest of the summer?
Really, the weather looks very favorable, and so it's going to be challenging to get any type of sustained rally. We're sitting, at some pretty major support levels on corn. But the markets, there's three phases, David. You go down, you go sideways, and eventually go up. And right now we're still trending lower. For wheat, we've had a bounce off of the recent lows, but that's primarily U.S. futures trading. Global wheat prices continue to move sideways to lower. So I really suspect that eventually July Chicago wheat's trading at 534. The September is trading at 545. I look by the end of harvest for that September to July continuation gap to be filled. And then you'll begin building a base. And then depending on acreage and global geopolitical factors, we can get a rebound up. But you've got to quit going down before you can talk about the markets going up.
Looking at the global marketplace as well, there's so many factors that influence our commodity prices. I think we have a very low US dollar at the moment, but also very low oil prices. We have issues going on that are causing some fertilizer concerns. How much of an effect are those impacting the markets right now versus their impact a couple of years from now because of supply chains?
Yeah, first of all, you mentioned US dollar. We're making new lows for 2025 as we're speaking today. But there's quite a lag from the time that you see the US dollar move lower till it really benefits US meat and grain exports, normally 3 to 6 months. And so we are starting to see it. The one commodity that is benefiting from low prices and low dollar is soybean meal. Goodness, we're at the lowest price since 2016. But having the dollar orderly, having it trend lower, and ultimately, if we take out support at 96, I think we go down to about 92. That's where we were when we really saw booming U.S. exports. So that's very positive. Crude oil, that's a two-edged sword. Higher gasoline prices and higher crude oil prices normally beneficial to ethanol. But as many people are working and lower gasoline prices allows them to have more money for buying meat, pork, beef, that type of thing. And certainly around the world, many of the nations that import a lot of grain also import a lot of energy. And so as their energy bill goes down, it allows the consumers to have more confidence and to be making more purchases. So again, there's a lag factor. I don't know enough about global economics, David, to give you a complete answer, but price does work, but a lot of times will take more time than what you think.
Absolutely. Let's do a quick jump into the meat market since you were talking about some of the export side of things there as well. We do have a historic low in cattle production at the moment. It doesn't seem to be changing. I saw the numbers seem to be lower a little bit more again this last cattle report from the USDA. Hogs seem to be standing pretty steady when it comes to production as well. Where is that level and balance of meat production as farmers see record highs for prices?
Yeah, we are seeing cattle. We're seeing a lot less cattle being available. It's one of the smallest cattle herds that we've seen in the last 20 years. However, lower number of cattle going in the feedlots does not necessarily mean lower total beef production. The animals continue to go heavier and heavier. When I was growing up, you'd feed a steer to 12, 1,300 pounds and ship it off to market. If you got it too heavy, they dock you for having too fat of meat, yield grade 5. Now, a lot of these bigger frame cattle, and with cattle prices where they're at, they're feeding up to 16 to 1,800 pounds. So we're kind of fixing the problem. We're also getting a lot more dairy cattle working their way into the supply. So the beef is, I think, a little sticker shock in here in many areas, and consumers are showing that they're switching over more to pork. Hogs have had a heck of a run in here. We're back to some of the best profit levels we've been at in 2 years. Some of that is consumers substituting, buying more pork rather than the expensive beef. But the other is that we've had, especially southern Minnesota, Iowa, man, the PRRS disease has really taken a toll on production. And a lot of these facilities are not able to produce the number of hogs that they were. So it's a combination of high-priced beef, reduction in supply in pork, and for the people that are able to stay disease-free, this has been a pretty historic run, and finally able to see some profits in the hog production.
One last note, as you look at the future of the livestock trade, what are some of the key points you're keeping an eye on as well?
Certainly supply of cattle coming in. We've seen a lot of volatility recently with the problem with the New World screwworm in Mexico. Mexico, working closely with the USDA, has been able to really reduce the number of that, and it hasn't worked further north. I think it's only in the bottom 2 provinces of Mexico. So far, thank goodness, it hasn't been working its way into the United States. The Mexican-American Department of Agriculture, USDA, has worked closely together. So we need to have that Mexican supply of feeder cattle coming in. And as that opens up, that does help reduce the supply problems that we're looking at in the U.S. So that's something that we're watching. On hogs, boy, they've done a really good job of promoting their product, and the people that are still in the business, very efficient producers, obviously with the last hog and pig report, and they're very what I call spreadsheet oriented, meaning that the larger guys, when they are able to buy corn, soybean meal, sell hogs at a profit, they just very business-like, they lock it in.
Al Kluis, Managing Director of Kluis Commodity Advisors, joining us. Al, is there a way for folks to get into contact with you or your team?
One really easy way is just to call us toll-free, 888-345-2855, or if you just Google my name, Al Kluis, Kluis, you'll find we have a very robust website. You can get signed up for 30 days of free information. Just log on and get 30 days of what we're thinking.
Al, thank you so much for joining us on Farm Here Daily.
Thanks, David.
Thanks again, Al. This is Farm Here Daily, a Field Forward podcast. Thank you so much for listening. Again, in order to continue to produce this type of local content, we would love to have you join our community. So please follow the podcast and check out our social media at Field Forward Pod. Additionally, you can find me on social media at Geiger Reports, as well as WHO TV Channel 13 every weekday in their morning and noon hour programs. Again, I am your host, David Geiger, and I'll be back again tomorrow, everybody.